Imagine waking up tomorrow to discover the global financial system is collapsing because the world's most trusted economy can no longer pay its bills. Right now, the United States government owes more than $33 trillion in debt. That's more than the combined economies of Europe, Africa, and South America. For nearly a century, this wouldn't have mattered. America was the world's financial safe haven. But something fundamental has changed. Since 2021, China has dumped over $340 billion worth of United States bonds. Japan, the United Kingdom, Germany, even America's closest allies are selling off their holdings. The world is losing faith in American debt. If everyone truly stops buying, the consequences could trigger the largest financial crisis in human history. The question isn't whether this matters, it's whether we're already past the point of no return. To understand how catastrophic this crisis could become, you need to understand how we got here. For the past 100 years, the United States has occupied a unique position in global finance. When governments, pension funds, or sovereign wealth managers around the world needed somewhere safe to park their money, they turned to United States Treasury bonds. This wasn't just preference, it was financial gospel. Buying American debt was considered the safest investment on planet Earth. Countries like Japan, China, and the United Kingdom didn't just buy billions in bonds, they built their entire financial strategies around the assumption that the dollar would never fail. The system was elegant in its simplicity. The United States government would issue bonds, essentially IOUs promising to pay back the money with interest. Foreign governments and investors would buy these bonds, effectively lending money to America. In return, they'd receive steady, predictable returns of around 2% annually. 2% might sound modest compared to stock market gains, but that's precisely the point. Stock markets crash, companies go bankrupt, but countries, especially superpowers like the United States, don't just disappear. This mutual arrangement created what economists call a virtuous cycle. Foreign countries wanted dollars to buy United States debt. This demand kept the dollar strong. A strong dollar meant cheap imports for Americans and gave the government incredible borrowing power. For decades, this system seemed unbreakable, but every system has a breaking point. Before we dive into the crisis, let's clarify how government debt works. When the United States government needs money beyond tax revenues, the Treasury Department issues bonds with different maturity dates. Some mature in months, others in 30 years. Investors buy these bonds at auction. The government gets immediate cash and promises repayment with interest. The interest rate depends entirely on demand. When investors trust the government, yields stay low and borrowing is cheap. But when confidence falters, the government must offer higher yields to attract buyers. This is dangerous territory. The United States holds $33 trillion in debt. Even small interest rate increases translate to hundreds of billions in additional annual costs. If you owe $100 at 2% interest, you pay $2 annually. At 5%, you pay $5, more than doubling your costs. Apply that math to trillions of dollars and the numbers become astronomical. The country has borrowed so much that even modest rate increases could make the debt mathematically unpayable. The modern debt crisis really began in 2008. When the housing market collapsed and dragged the entire financial system down with it, the United States government faced a choice. Let the economy burn or spend whatever it takes to prevent total collapse. They chose to spend. The Emergency Economic Stabilization Act pumped $700 billion into failing banks. Then came the American Recovery and Reinvestment Act, another $831 billion for infrastructure, tax cuts, and direct relief. These weren't small numbers. Combined, these emergency measures represented more than 10% of the entire economy at the time. And it all went on the national credit card. From 2008 to 2020, United States debt increased by more than 30%. By the end of this period, every American citizen effectively owed approximately $80,000 in government debt. But here's what made this manageable, at least temporarily. Interest rates were near zero. The entire world was terrified after the financial crisis, and everyone wanted the safety of United States bonds. This demand drove interest rates to historic lows. The government could borrow trillions, and the interest payments remained relatively affordable. Economists called this the era of free money. The United States was essentially borrowing at zero cost. Of course, this created a dangerous dependency. The entire strategy relied on maintaining rock-bottom interest rates forever. Any spike in rates would make the debt burden unsustainable. But in 2008, nobody thought rates would ever rise significantly again. They were wrong. If 2008 was concerning, 2020 was catastrophic. When COVID-19 shut down the global economy, governments faced another impossible choice. let millions of businesses fail and unemployment skyrocket, or spend unprecedented amounts to keep the economy alive. Once again, the United States chose to spend, but this time, the spending made 2008 look restrained. Stimulus checks went out to nearly every American household. Businesses received hundreds of billions in bailout funds. Unemployment benefits were expanded dramatically. The Paycheck Protection Program alone cost $800 billion. By the time the pandemic emergency measures ended, the United States had added more than $5 trillion to the national debt. That's an additional $15,000 per person added in just a few short years. For the first time since World War II, United States debt exceeded 100% of gross domestic product. The country now owed more than its entire economy produced in a year. This crossed a critical psychological threshold. Investors began to wonder, can America actually afford this? The answer wasn't obvious anymore, and that's when the foundation started to crack. Remember, the entire system depended on confidence. As long as everyone believed the United States would always pay its debts, the system functioned. But once doubt crept in, once investors started questioning American solvency, the downward spiral could begin. And that's exactly what started happening. The warning signs appeared quietly at first. In 2021, China, the world's largest holder of United States debt, began selling. Not a little. They dumped $340 billion worth of Treasury bonds over the following years, reducing their holdings by more than a quarter. Next came Japan, the second largest holder. They sold roughly $200 billion. Then the United Kingdom started selling. Then Canada, then Germany. Even America's closest allies were reducing their exposure to United States debt. At first, financial analysts offered reassuring explanations. China was diversifying. Japan needed to support its own currency. These were routine portfolio adjustments, nothing to worry about. But as the selling continued and accelerated, a darker reality emerged. The world was losing confidence in American debt. The numbers tell the story. Foreign holdings of United States Treasury securities peaked and then began a steady decline that continues today. This wasn't diversification, this was a slow-motion exit from American debt. If you're enjoying this video and want to stay informed about critical economic developments like these, make sure to subscribe for upcoming analysis and breakdowns of the forces shaping our financial future. The implications are staggering. For decades, the United States relied on foreign buyers to fund its deficit spending. When you spend more than you collect in taxes, someone has to lend you the difference. Foreign governments filled that role, buying trillions in bonds year after year. But what happens when they stop? What happens when the buyers disappear? When demand for any asset falls, its price drops. For bonds, a falling price means rising yields, and rising yields mean the government must pay more to borrow money. This creates what economists call a death spiral. Let's walk through the mechanics. Imagine the Treasury Department needs to borrow $100 billion to cover this month's deficit. They auction off bonds, but if foreign buyers aren't interested, there aren't enough bidders. To attract buyers, the government must offer higher interest rates. Let's say rates jump from 3% to 5%. That doesn't just affect new borrowing, it affects all future borrowing. And remember, the United States doesn't just borrow once. The government constantly rolls over old debt, issuing new bonds to pay off maturing bonds. Every time old bonds mature, the government must refinance at whatever the current interest rate is. If rates are rising, each refinancing becomes more expensive. The numbers become nightmarish quickly. The United States currently pays approximately $3 billion every single day just to cover interest on existing debt. That's over $1 trillion per year. A 2% increase in average interest rates would add another $660 billion annually. For context, that's more than the entire defense budget. The government would be spending more on interest than on the military, more than on education, more than on infrastructure. Over the next decade, if interest rates remain elevated, Americans could each face an additional $40,000 in debt interest costs. That's money that could have funded healthcare, repaired roads, or cut taxes. Instead, it's flowing to bondholders, many of them foreign governments. This is the interest rate death spiral. Higher rates mean higher costs mean more borrowing. More borrowing with fewer buyers means even higher rates. The cycle feeds itself until something breaks. Rising interest rates aren't even the worst part. The real catastrophe would come from currency collapse and inflation. When foreign investors sell United States Treasury bonds, they're also selling dollars. A Japanese pension fund converting bonds back to yen first sells the bond for dollars, then sells those dollars to buy yen. Multiply this by trillions of dollars. All those foreign investors selling debt means massive dollar sales. Basic supply and demand, more dollars flooding the market, fewer buyers, plummeting value. The United States imports approximately $4 trillion worth of goods annually. That's a quarter of all manufactured goods and a fifth of the nation's food supply. When the dollar weakens, imports become much more expensive. Coffee from South America costs more, electronics from Asia costs more, gas from foreign oil costs more, everything at major retailers costs more. Even American-made products aren't safe because manufacturers rely on imported components. If those inputs cost more, final products cost more. Wages can't keep up, savings lose value. Venezuela provides a chilling preview. In the early 2000s, Venezuela was South America's richest country, but heavy borrowing created dependency on foreign confidence. When oil prices crashed and investors lost faith, Venezuelan bonds were dumped. The currency collapsed. Inflation spiraled out of control. Today, Venezuelan inflation still exceeds 100% annually. The country went from prosperity to poverty in a generation. The United States isn't Venezuela, but the underlying mechanics are identical. Lose investor confidence, lose currency value, unleash inflation. An American debt crisis differs from other countries' problems. Because the United States dollar is the global reserve currency, the foundation of international finance, central banks worldwide hold trillions in dollar reserves. When their currencies face pressure, they use those reserves to stabilize their economies. If the yuan weakens, China sells dollar reserves to buy yuan. If the euro falls, Europe does the same. The system depends on the dollar maintaining value. But what if the dollar collapses? What if those reserves become worthless? Every dollar-backed currency suddenly loses its backstop. Countries that thought they had safe reserves discover those reserves can't protect them. This is systemic risk on a global scale. We're talking about collapse of the international monetary system that's existed since World War II. Trade between countries would seize up, supply chains would shatter, countries would hoard essential goods, stock markets worldwide would crash. This isn't speculation. When the British pound lost reserve status mid-20th century, it triggered decades of stagnation for the United Kingdom. An abrupt American collapse would be far worse. China knows this. That's why they're already working on alternatives, pushing the yuan as a reserve option. Some nations are settling trade in euros, gold, or digital currencies. These moves are happening now, and every step toward an alternative system weakens the dollar further. So what can the United States do? There are essentially two options, both politically toxic and economically painful. The first is fiscal austerity, cutting spending to reduce deficits and stabilize the debt. In theory, this is straightforward. If the government spent less than it collected in taxes, it could start paying down debt. Lower debt means less interest, which means more budget flexibility, which means easier debt management. Problem solved. Except it's not that simple. Here's the political reality. Voters don't elect politicians who promise to cut government services. They elect politicians who promise more services and lower taxes. Cutting spending means making enemies. Cut defense spending, the military and defense contractors revolt. Cut Social Security or Medicare, retirees and seniors revolt. Cut welfare programs, the vulnerable and their advocates revolt. Cut anything, someone powerful gets angry. This is why, since the 1980s, the United States government has run a budget surplus in only 4 years. 4 years out of more than 40. Every other year, the government added to the debt. Recent attempts at spending cuts have been modest at best. Even ambitious proposals to eliminate government waste have saved only tens of billions of dollars. That might sound significant until you realize the government pays $3 billion per day in interest. Savings of $40 billion covers less than 2 weeks of interest payments. Real debt reduction would require cuts to the biggest budget items: Social Security, Medicare, Medicaid, and the defense. Spending combined account for about 2/3 of the federal budget. You can't meaningfully reduce the deficit without touching these programs, but touching them is political suicide. Any politician who seriously proposes major cuts to these programs will face immediate backlash from voters who depend on them. This is the austerity trap. The spending cuts needed to solve the crisis are too painful for any democracy to accept voluntarily. By the time the crisis forces action, it may be too late to avoid catastrophe. If cutting spending is politically impossible, that leaves one alternative. The Federal Reserve could create money to pay off debt. This is called monetizing the debt, and it's exactly as dangerous as it sounds. The Federal Reserve buys Treasury bonds using newly created dollars. The Treasury gets cash without needing external buyers. But printing money to pay debts is financial suicide for a reserve currency. Investors bought United States bonds trusting they'd hold value. If the government prints money to repay debt, those bonds don't hold value. They're repaid with devalued currency. This destroys any remaining confidence. If investors know the government will print rather than honor obligations at full value, why buy bonds? Future borrowing becomes impossible. Interest rates spike as remaining buyers demand huge risk premiums. The inflation consequences are even worse. Every dollar printed dilutes existing dollars. More money chasing the same goods means prices rise. If the government prints trillions to pay debt, inflation explodes. History provides clear warnings. Germany in the 1920s, Zimbabwe in the 2000s, Venezuela today. The pattern is always the same. Print money, destroy currency, devastate economy. For the United States to go down this path would represent complete policy failure, an admission that the government chose to destroy its own currency rather than make hard decisions. The dollar's reserve currency status would end immediately. So where does this leave us? The United States faces a debt crisis with no painless solution. Cut spending and face political upheaval while potentially triggering a recession. Print money and destroy the currency while betraying creditors. Do nothing and watch interest payments consume the entire budget until the system collapses under its own weight. The warning signs are everywhere. China, Japan, and other major holders are selling. Interest payments have reached historic highs. Confidence in the dollar is eroding. New rivals are positioning their currencies as alternatives. Yet despite these signals, there's no serious political will to address the problem. Tax cuts remain popular. Spending cuts remain toxic. The deficit grows every year. At some point, the bond market will force a reckoning. It might not happen this year or even next year, but it's coming. When foreign buyers finally lose faith completely, when they decide American debt is too risky, the crisis will explode seemingly overnight. Interest rates will surge, the dollar will plummet, inflation will soar, and millions of Americans who never paid attention to government debt will suddenly understand why it mattered. The tragedy is that solutions exist. A combination of modest spending restraint, tax reform, and economic growth could stabilize the debt over time. But these solutions require political courage, long-term thinking, and short-term sacrifice. Three things in desperately short supply. What happens if everyone stops buying United States debt? We're starting to find out. And unless something changes dramatically, the answer will reshape not just the American economy, but the entire global financial system. The age of cheap American debt is ending. What comes next could define the 21st century.